Hey everyone, this is Hunter Satterfield. I am the Chief Investment Officer of Kane Waters, as well as one of our partners here. As always, today I am joined by my fellow partner and the head of our investment committee, Brian Bortz, and then, of course, Brad Sanders, the Managing Director of Tectonic Advisors. This is your February market update. For the month of February, the S&P was down 1.3%, with global stocks off 0.9%. We had bonds actually up 2.2% on the domestic side and up 1.4% on the global bond side. Interestingly enough, the month of February felt quite a bit more choppy, which we'll certainly talk about with Brad and Brian, than those numbers indicate. Just in the last 30 minutes of trading last Friday before the end of the month, the market shifted a full 2% higher. It was a very volatile month, which we'll talk through all the stuff related to the trade wars here shortly. Interestingly enough, also, since the election, we actually now have bonds that are outperforming stocks. So bonds are up 2.1%, with U.S. stocks only up 1.6% since the end of the election. So fascinating stuff, guys. And actually, we're going to go to Brad here in a second to talk really detailed about the trade war. But as of this recording this morning, Brian, I want to come to you because as of the recording this morning, we've got tariffs back on for Canada. We've got them back on for Mexico. We've got double the tariffs for China as well. And we're getting a lot of questions from clients about what this means. And again, we'll come for some more detailed comments from Brad. But you want to talk a little bit about what you're telling clients on what this means for their portfolios?
Yeah, thanks, Hunter. President Trump said that he was going to do this, and he's doing it. And it's really a little bit of, the reasoning behind it is to try to treat other countries as the perception is they're treating us. It is a negotiating ploy as much as it is a real economic tariff, but it's economic reality now, and everyone's talking about it. It's in every piece of financial literature that's out there. So much so that my 19-year-old daughter, who is in college, sent me a TikTok link this morning asking about, hey, can you explain this and what's going on, what it means? So it's out there, guys. Today is the day that it's going to be happening. And really what it means for the economy, potentially, is if it's not just a negotiating ploy and it actually sticks around for a while, it could mean that it slows the U.S.'s economic growth for a period of time. Could also potentially be inflationary to the extent that it could raise prices. So it could have some impacts on what we do. Really, at the end of the day, whether it is a negotiating ploy or something that is here to stay, the fact remains that it's just going to increase the volatility that we're going to see in the markets for the near term. So that's really what I'm telling clients, Hunter, is, buckle up. You're going to have the volatility that we talked about. And it's not always going to be a bad thing, but it is here for a little while. So that's what I'm telling them.
Yeah, all interesting info. And we'll give some resources at the end, folks, for you to be able to kind of deep dive tariffs if you're interested. But Brad, I want to come over to you. So we've got Apple that's now, moving some manufacturing here domestically from previous investment they were going to make in Mexico. Same thing yesterday with TSMC, which is a massive chip manufacturer. They will be moving manufacturing here to the United States as well. So much of this obviously follows the conversation related to tariffs, but we are at this point probably entering a full-blown trade war. You want to talk a little bit about what your team at Tectonic is sort of seeing behind the scenes, thinking through as far as the next 30, 60, 90 days goes?
Yeah, I think it's kind of a follow-on to the conversation we've been having for months after post-election that the Trump's policies are going to cause volatility. I guess the bright spot would be also what we've been talking about is the broader market outperformed the cap-weighted indices by a lot in February, and value was actually positive, like 40 bips versus growth being down 3.6. So a lot of the themes in our portfolio continue to work, but we're going to have to deal with some real economic volatility going forward. And unfortunately, with kind of the way these tariffs have been put on, they're on one day, they're off, now they're on again today, and there's a lot of this jabbering back and forth. The market's going to have a real hard time finding directionality until we get tariffs in place and we kind of sit with them. And at that point, you're going to be able to really determine the economic impact 3 to 6 months later, which will in turn start having some CPI reflection and then maybe getting some Fed reaction to that. So we're going to have to get through the first 2 quarters of this year with a lot of economic volatility, which is going to translate into stock market volatility. And without that directionality element, with how high the market was priced due to the skew from the Mag 7, the path of least resistance is going to be for the market to grind lower. Doesn't mean that we're going to go down the whole time. If the broader market's outperforming, that's going to help our portfolios. But if you're an index investor, it's probably not going to be fun for a while. I met with all three of our fixed income managers in one day 2 weeks ago. Together, they manage almost $4 trillion. So you can kind of imagine the amount of economists and people they have on their team. When you have command that much AUM, they have a lot more resources than everybody else. PIMCO, for example, Ben Bernanke and Alan Greenspan are on their advisory board. So they get a little bit better detail than I mean, I trust their math. But basically, the way to think about these tariffs in a vacuum is that for every 1% rise to the PCE, which is the personal consumption expenditures, which is what the Fed looks at when they're determining policy, for every 1% rise in that, you get a 0.1% bump to CPI. Okay. If everything that Trump has mentioned to date gets enacted and stays that way, that's going to raise prices by 8% across the board because tariffs are inflationary in a vacuum. We've talked about that. So you're looking at a 0.8% bump to CPI. So we're looking at CPI sitting in the mid threes in a vacuum. Now, when you enact tariffs, which you talked about, Hunter and Judson did a great podcast about it, there's a lot of offsets. It doesn't happen exactly the math the way I'm talking. But we're going to be looking at, a stagflationary period while these tariffs get enacted. And then once we get through that, we're going to be able to see, the forest through the trees and have some Fed follow on. It's just going to take a while and it's going to be bumpy, folks.
Yeah, thanks, Brad. And for those that are wanting to deep dive it a little bit more, episode 221 of the Accumulating Wealth podcast that posted on February 25th is a great place to sort of go and listen to what tariffs are, what is the history behind them, and what they mean. As always, gentlemen, amazing. Thank you so much for the time on this. We will be back in front of everybody at the end of March with certainly another 30 days of interesting markets to explore. Thank you so much.